Hello and welcome to lecture 2 in this lecture series on the subject of Principles of Insurance. This lecture series is based on the syllabus fixed by the Insurance Institute of India in 2025 and is designed to help those who would like to watch and listen to lectures to understand the subject and write the exam conducted by the Insurance Institute of India. This lecture continues to deal with chapter 1 and will cover the topic risk management. Just a recap of the last lecture, we had dealt with what insurance is. We saw that in insurance, small contributions called premiums collected from a large number of people and are pooled in a common fund. Those who suffer losses get to be compensated from that common fund. This is the basic aspect in insurance. We also saw about the topics risk and adverse deviation, where there is a possibility of financial loss owing to deviation from the expected or desired outcome. We also saw the differences between pure and speculative risks and that insurance is chiefly concerned with pure risks where there are only two outcomes: no loss or loss without chance of gain, and that the cause of loss such as fire, death, etc. is due to factors beyond the control of the person suffering it. We also saw the reasons why insurance is not concerned about speculative risks. Please feel free to access the last lecture from the link provided in the description to this video. Now, let's come to today's topic. Risk management is the discipline of identifying and managing the risks of an individual or enterprise. While insurance primarily deals with pure risks, risk management is a much broader concept that handles both pure and speculative risks. This is an important distinction. So let's take a look at the diagram here on the slide to visualize it. You can see how risk management covers a wider domain of risks than insurance does. For any enterprise, risk management has three main aspects: risk identification, risk evaluation, and risk treatment. Let's break down each of these steps. Risk identification. The first step is to figure out all the risks that your enterprise is exposed to. This isn't a casual exercise. It requires diligent identification and documentation of every conceivable risk that could lead to an economic loss. It involves a review of the enterprise's history of past losses and near misses, as well as those of similar businesses. This information is then compiled into a risk register, which serves as a comprehensive record of all identified risks. Next is risk evaluation. Once there is a list of risks, the next step is to evaluate them based on their potential for causing a loss. Consider two key factors: severity and frequency. Severity refers to the magnitude of the loss when it does occur. Frequency refers to how often a loss is likely to happen. The gravity of a risk or the potential loss in economic terms is calculated by multiplying its frequency by its severity. This allows classification of risks and prioritize which one needs more attention. Risk treatment. After identification and evaluation of risks, it must be decided how to treat them. There are four primary methods for risk treatment: avoidance, mitigation, transfer, and retention. Risk avoidance. Sometimes the best way to handle a risk is to simply avoid it. This is often the case for speculative risks that have both high severity and high probability. For example, not choosing to build a factory in an area with high seismic activity. Insurers might be hesitant to cover such risks or might charge extremely high premiums. Other examples of avoidable risks include investing in high-cost, rapidly obsolescing technology or entering into a highly competitive and cutthroat industry. Remember, there is always a trade-off between risk and reward. If the decision is to take on the risk, then risk management is a solution. Risk mitigation. Risk mitigation aims at lessening the impact of a risk and has two key elements, prevention and reduction. Prevention focuses on stopping a loss from happening in the first place. This is a vital part of risk management as it directly reduces the frequency of accidents. Think about adopting safety measures like wearing helmets and seat belts, installing speed bumps in accident prone areas, or maintaining good housekeeping to prevent fires. Reduction acknowledges that one cannot always avoid accidents entirely, so it focuses on minimizing the severity of the loss when accident inevitably occurs. Examples include having fire extinguishers and sprinklers on hand, conducting safety drills, using improved packaging, or having better automobile designs. Remember the gravity of risk formula. Loss is measured by multiplying frequency with severity. Risk transfer. Risk transfer involves shifting the financial burden of a risk to another party. The most common example of this is insurance, which is a vital risk transfer mechanism. Your risks like fire or theft can be insured. You pay a premium and in return, the insurer indemnifies you for your loss. But remember, not all risks can or should be insured. And insurance isn't the only way to transfer risk. Other examples include reinsurance, where an insurer transfers some of their own risk to another insurer to spread it across many enterprises. Hedging companies that manage risks related to exchange rates and interest rates fluctuations. Investment bankers who underwrite initial public offerings to manage the risk of undersubscription. Manage the risk of undersubscription. In case of IPOs, that is initial public offers, the company that is undergoing that IPO process enters into an agreement with an investment banker stating that in case the public undersubscribes to the shares, then the investment bankers will buy the undersubscribed shares. Risk retention. Finally, there are some risks that are simply not feasible to avoid, prevent, reduce, or transfer. In these cases, the enterprises must retain the risk and be prepared to finance any potential loss. This might involve building up capital or creating dedicated reserves to cover any loss when such loss occurs. So, to recap, risk management process involves three steps. The risks are identified, evaluated, and treated. The treatment can be a combination of mitigation, transfer, or retention. Insurance is a very important part of this process, but it's just one piece of the puzzle. Understanding these concepts is crucial for making a sound decision for any business or individual. If you have any questions about these different risk treatment methods, please feel free to comment on the video or email to lawbadri@gmail.com. Bye bye and stay safe.